My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, teach, put it all in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sure, we've only had a few quarterly reports so far in the season, but the ones we have had must be considered knockout blows to the crash landing recession thesis that's dominated discussion for well over a year now. And that's why the Dow jumped 367 points today, S&P advanced 0.71%, NASDAQ gained 0.76%. Until this earnings season began 1 week ago, there was a widespread perception that a looming recession was going to destroy the stock market. Now, the prescription went like this. In order to slow down the economy and crush inflation, Fed Chief Jay Powell would have to cause a recession. You couldn't cram down 10 rate hikes in a row, including some very big ones, without the economy falling apart, right? Seems logical. Plus, if there were any doubt that a recession was inevitable, all you had to do was look at the yield curve, which is inverted, meaning longer-term rates are far lower than short rates. Long-term rates lower than short rates. Economic orthodoxy says that's an imminent sign of a recession. And it is, but it's also a simultaneous of false positives. Everybody figured a severe slowdown, though, was a sure thing. And that's why you always heard about this hard landing, meaning that the economy was like a plane or a train about to crash. Now, it turns out that the orthodoxy is failing. Its true believers right now are wondering because they keep getting it wrong. First, it was housing. When you raise the cost of financing, you depress the cost of a home, or at least we thought so. But there's a severe housing shortage in this country. We might have 5 million homes, excess demand. 5 million homes we need, and that's driven housing prices up 40% in the last 5 years. We never thought there'd be a housing shortage. Each time the Feds raised rates, it was supposed to cool the housing market. In reality, it's done next to nothing because so few people want to sell their old homes that they refinanced with ultra-low mortgage rates during the depths of the pandemic. The main buyers right now are actually cash buyers. They don't even care about rates because rates are irrelevant to them. Yes, there's so much money sloshing around in residential real estate, although the actual price of a home doesn't show up in the CPI. It reverberates throughout the system, and it's been a huge cause of inflation. Also, a seemingly intractable one. I say seemingly, though, because we did get a rent number recently that indicated that rents have stopped going up, which suggests that maybe there are enough units, at least rentals, around. And that would be godsend for the Fed. Anyway, we know the stocks of the home builders should have been the worst performers out there because of the relentless rate hikes. But they turned out to be among the best performers because of the housing shortage. To add insult to injury, we just got some numbers today that show a downtick in forbearance, a seemingly impossible, paradoxical figure, given that rates go higher when we're actually supposed to get a downtick, an uptick in defaults, not a downtick. Higher rates mean more people are supposed to default. We have no people to force from their homes because everybody's paying their mortgages on time. Or, of course, they're paying it in cash and don't have to worry about a mortgage. Then, in another classic contradiction, we have a roaring bull market in the transports, the truckers, the airlines. Now, I don't buy into the yield curve orthodoxy, but I am much more confident in Dow theory orthodoxy, which says you can't have a real bull market unless the Dow transports are confirming it. So it's vital to see the transports hitting new highs like they've done over the last few days. Suffice to say, you're not supposed to get this kind of action at this point in a rate hike cycle. When the Fed tightens, we expect to crush the commerce. And that just hasn't happened. I know that some of this strength has to do with the monster run FedEx in light of a possible strike at a competitor, UPS. But you can't asterisk the transports. You just claim it. Delta Air reported last week it was a clean beat and raise, so don't get caught up in the minutia. I think you go higher. Now, look, a minor word of caution. Trucker J.B. Hunt reported tonight and missed expectations. So tomorrow could be a tougher day for the group. More bullish data, though. We had a call last week from PepsiCo. More on them later. But they mentioned multiple times that there's been no trade down in price. This is interesting because it's not supposed to happen for 10 rate hikes. You're supposed to have a trade down. The consumer usually won't stand for such increases at this point in the cycle. But PepsiCo shockingly said there's no problem. There's nobody buying that house brand of soda. The real doubts about this recession thesis has been sown by the banks. First, J.P. Morgan reported a juggernaut group juggernaut growth quarter, the strongest quarter I've seen since Pierpont Morgan managed the place in what we call the corner, which is right down there. I kid you not. JP Morgan's become the savior of the financial system again, just like it was in the early 1900s when it was the lender of last resort during panics. Similar to back then, they also make a lot of money when they save the day. This time it was with First Republic. JP Morgan's already killing it with that franchise that was filled with millionaires that collapsed during the mini crisis earlier this spring. They ultimately bought this thing for what will end up looking like, I think, pennies on the dollar. Then we got a report from Wells Fargo, same day, that was just stellar. The company's making a huge amount of money risk-free with its monster net interest margin. 10% we thought, no, it turned out to go on to 14. Now, given the mini crisis in banking, there was bleed off of many institutions, but not Wells. Because of previous sanctions, it wasn't allowed to be as free with its capital as other banks. So Wells was flush with cash, allowing them to crush it. Plus, remember the big commercial real estate crisis? Wells analyzed every one of its office buildings and came away pretty sanguine. And I trust Wells. I trust Charlie Scharf, the CEO. Sure, the regionals, which were all up today, may have been deposit donors to these big banks. We don't know yet. But I'm beginning to just wonder whether they're even dangerous. Now, we knew that there had to be another shoe that was going to fall in the bank mini crisis, and that was supposed to be Schwab, which has a banking business on top of its famous brokerage business. And supposedly, the bank's bond holdings were very dangerous. I kept insisting this was an absurd worry, as the company itself was never in doubt. There was no online banking crisis. Sure enough, the short sellers were all over it. The brokerage business meant nothing to them. Betting this little bank appendage to the brokerage would lead to a real run on the story firm, no. Not only was there no run, but Schwab's brokerage business, the online business, showed massive inflows. I think the $66 stock, even though it's up 12% today, can go still higher. That's how low this one had fallen. That's how great this franchise is. Today, the largest commercial bank in the country, Bank of America, reported a magnificent quarter, making it clear that the consumer is incredibly strong and flush with cash. If the bears were right about the inevitable recession, it'd be the opposite. A strapped consumer, out of cash, hanging on by her fingertips. Defaults are minimal, including defaults in the dreaded commercial real estate space, which I keep telling you was a well overdone crisis. Not to be outdone, Morgan Stanley's proven that its new Model 1 of asset gathering has made it immune of whatever the bears lay out, because it's taken about $200 billion in year to date. This investment bank made an immense amount of money without much of an IPO market or even an M&A market. Morgan Stanley even mentioned that things are getting better on both fronts. As CFO Sharon Yeshaya said, and I quote, across investment client activity trended positively as the quarter progressed. The pre-announced M&A backlog grew consistently throughout the quarter, with a potential plateau in rates and lower implied volatility. Client dialogue is currently active, end quote. You know what that's called? That's called a great cadence. And that's what sent this charitable trust name roaring 6.5% higher. The bottom line here, those who cling to the notion that we're about to enter a recession must find all these examples daunting, if not depressing. But earnings season has shown the recession thesis just doesn't hold up under close scrutiny, even if so many so-called experts tell us otherwise. Lori in Massachusetts. Lori.
Yes. Cramer, hi.
Hi, Lori.
Lori from Lynn in Boston. How are you?
I am good. How about you, Lori? What's up?
Okay, so my question is today about Carvana. And so I bought some today at 39 towards the close. And then after hours, I seen it trading at 35. So I bought more after hours.
Let me tell you what I think. First of all, we don't know. We don't know what's happening. Why? Because Carvana said it's going to move up its earnings till tomorrow. That's far in advance of when we thought. And what people are saying, well, it must be bad. I say, I don't know. Sometimes, Lori, the best words in the language for stocks is, I don't know. And this is one of those. How about James in South Dakota? James. James, you with me?
James.
Oh, Anthony. I'm sorry. It's Anthony. I'm sorry. My bad. What's going on?
Actually, I own Micron, and I'm worried that they're being left behind by all the other semiconductors, to be honest with you.
Well, I got to tell you, the way this is one, let me tell you the way this one works, Anthony. Micron bottoms well in advance of when its business is good. Sanjay Mehrotra has made a point, the CEO, to me over and over again, we're not at the bottom yet. But you have to anticipate the bottom. That's the way Micron works. And it's $64.94. I say you are okay. But be prepared to buy more stock at 60. Now, the tide is turning in favor of the bulls. And the bears out there still clinging to the recession thesis. They are running out of ammo. They know nothing. On Mad Money tonight, we're continuing our series on the enterprise software space stocks that you never, ever see yourself, but are making a ton of money. And they are second-tier winners who continue to thrive in this red-hot cohort. Hey, one of them, I think, is going much higher, much, much higher. Then we've entered earnings season with a fairly confusing backdrop for the broader market. So what can investors expect from the major averages as we get inundated with more reports? I'm going off the charts to find out, and it's pretty interesting and different from what I thought. And Splunk didn't quite make our list of enterprise software comeback stocks, but bouncing off its lows, story's still intriguing. Great CEO. I'm checking in with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.